Welcome to the deep dive. Today, we're cutting through a lot of the noise and delivering what we hope is the ultimate shortcut into a really specific and highly influential trading methodology. We're talking about the foundational core content of the 2016 ICT Private Mentorship, and we're zoning in on just month '01. Our mission here is to try and transform your understanding of how price moves. This isn't just theory, it's about completely abandoning that typical retail mindset, the charts just cluttered with indicators and patterns, and instead learning the specific language of institutional order flow. We're providing the framework, the lexicon, really, and the initial context you need to see the market through a completely different lens. But before we open that lens, we have to start with a necessary disclaimer.
Precisely. And this is important. This information is general commentary on market structure. But as we discuss these concepts, you have to remember the U.S. government-required disclaimer. Futures and options trading has large potential rewards, but it also carries large potential risk. You must be aware of those risks and be willing to accept them in order to participate, and never, ever trade with money you cannot afford to lose. The information we talk about here is generalized, it's educational, and it's not specific trading advice. Past performance is never indicative of future results, so please, trade at your own risk.
Soundly noted. Okay, so let's unpack this fundamental shift. Month '01, it really kicks off with I think, a revolutionary concept, that price action is not random. It's actually dictated by just a few predictable conditions. We have to forget the idea that price is constantly doing something new and just accept that it only moves in four primal ways.
That is the critical first insight. Price delivery can only be governed by four primary states. You have expansion, retracement, reversal, and consolidation. Every single tick you see on a screen, every single one, falls into one of those buckets. Understanding which state you're in or which one might be about to happen is the absolute foundation of institutional thinking.
And of those four, I'm guessing expansion is the one we should zoom in on first, right? I mean, because it leaves the clearest footprint.
Absolutely. Expansion is defined by speed. It's when price moves very quickly, very powerfully away from a level of short-term equilibrium. And why is this quick movement so critical? Well, because it's the institutional entity, the market maker, basically shouting, "This price is wrong, we are repricing rapidly." It reveals their true directional intent. And this leads us directly in the concept of the order block. So the expansion is the explosion, right? The order block is the ignition point. For a bullish expansion, that's a fast move up. You look at the last down-closed candle, the last black or red candle, right before that rapid move began. That specific down candle is the bullish order block.
Wait, hang on. Let me make sure I've got that, because that feels counterintuitive. You're telling me that to anticipate buying, we're focusing on the very last candle where smart money was apparently selling.
That is exactly right. It seems backward, but that down candle represents the institutional selling that was required to accumulate the fuel all the orders needed to launch price in the opposite direction. The strategy isn't to chase the price during that big expansion. The high probability strategy is to wait. Wait for the price to return, to retest that specific order block level later on, and only then do you consider buying.
That makes so much more sense. It turns that explosive move from a signal you have to chase into an area you just have to wait for.
Okay, so expansion is the burst. What about the other three? The others really just define the other phases, like waiting or turning. So consolidation is simple. Price is just holding in a tight, defined trading range. It's an equilibrium. Retracement is when price moves back inside the range it just created, maybe to revisit that order block we just talked about. And then finally, you have reversal. That's the market turning point, signaling a real change in the larger directional bias. The market is just constantly cycling through these four states.
Okay, so if we know how the price is moving, expansion, retracement, and so on, the next logical question is why? Why do specific levels attract that movement? Why does price explode from one point but just stall at another? That, I guess, gets us into institutional valuation.
Correct. We have to change how we measure price swings. Institutional order flow focuses entirely on valuation relative to the immediate price swing. We measure that swing from its recent high to its recent low, or, vice versa, using the Fibonacci tool, and we find the absolute midpoint.
That midpoint, the 50% line on the Fibo, that's what's called equilibrium. I kind of like to think of this like shopping.
That's a great analogy. Equilibrium is the point of fair valuation. If you see price trading below that 50% line, you are in a discount market. Think of it as the institutional sale rack. This is the high probability area for smart money to be buying or covering their existing short positions. And conversely, any price activity above that 50% line means you're in a premium market. This is where smart money is most likely selling, liquidating long positions they bought cheaper, or maybe establishing new short positions.
Okay, and this is where it gets really interesting and really specific for potential entries. Because if discount is below 50% and premium is above 50, the source material then defines this sweet spot, the optimal trade entry, the OTE. The OTE is this very precise zone. So when you're looking to buy in a discount, the most sensitive OTE levels are specifically the 62, the 70.5, and the 79% retracement levels of that swing. These three levels are basically measuring how deeply discounted the prices become relative to that recent range. And for selling, you just look for the mirror image above the 50% line.
This flips the retail mindset completely on its head. Most retail traders are taught to sell breakouts or buy momentum, which, often means buying high in a premium or selling low in a discount. Institutional money does the exact opposite. They liquidate their longs at a premium where price is high, and they accumulate new longs at a discount where price is low. Understanding that OTE zone is understanding exactly where the smart money is most likely to act.
We've just analyzed the anatomy of a single price swing, the order block, the expansion, the discount, the premium. But what is the giant, the macro force that's powerful enough to orchestrate these massive swings and commit capital at that kind of scale? We have to zoom out.
If we want to talk about the grand puppet master behind major financial market moves, we have to talk about interest rates. The sources are crystal clear on this. Interest rates are the single most influential driving force. If you ignore the rate environment, your technical analysis is missing the most important piece of context there is. The ability to understand shifts in these key rates, it helps so much in trade selection. In fact, technical analysis of the key interest rates themselves is explicitly how you unlock professional money movement patterns.
And how do we track that massive underlying force visually? I mean, how do you see it on a chart?
We use what are called the interest rate triads. It's for a visual depiction of smart money activity. We look at three key instruments. First, the 30-year bond, which represents the key long-term interest rate. Then the 10-year note for the intermediate term rate. And finally, the 5-year note, which represents the short-term rate. The application here is a form of comparative analysis. You overlay them or you look at them side by side. If, for instance, you see the 30-year bond, the long-term rate, suddenly fail to break a key prior low, what we'd call a failure swing, and the other two notes confirm that same behavior, it can validate with very high certainty the institutional order flow in correlated assets like, say, the currency markets or the indices.
So the macro fundamental picture, the interest rates, feeds into the micro price structure, the discount and premium. And the final layer of this foundation is the mechanism that ensures these moves happen predictably every day, the interbank price delivery algorithm, the IPDA.
Exactly. The IPDA is the underlying mechanism that drives price delivery, and yes, it is inherently slanted toward the benefit of the large institutional entity, the smart money. While the algorithm itself is vast, the simplified IPDA daily range structure provides a very reliable, very repeatable template for anticipation.
Can you walk us through what that typical daily cycle would look like?
Certainly. So the day typically begins with price equilibrium, which you often see during the quiet Asian range. Then comes the critical phase, manipulation. This is the engineered false move, often called the Judas swing, which is very often catalyzed by key news releases. Its purpose is to trap uninformed traders, the retail crowd, into believing the wrong directional move is starting. It ensures there's liquidity available for the smart money to enter cheaply.
So if the institution wants to buy, they first push the price down to shake out the weak holders and entice all the early sellers, and then they use that volume to fill their long positions.
Precisely. And once that manipulation has cleared the necessary stop losses and trapped the uninformed, you then see the intended directional move, which is the range expansion. After this initial run, you often get a smaller consolidation or a retracement, like the New York consolidation, as they pause to reaccumulate or maybe redistribute. And that's usually followed by another expansion or even a reversal to complete the daily objective. This predictable model allows the informed trader to anticipate the next move when price comes out of a quiet period.
Now, if the IPDA is meant to benefit the smart money by trapping the uniformed, how can a learner possibly anticipate it without being the victim of that Judas swing every time?
The key is observation. The IPDA always targets specific, measurable levels of liquidity, which brings us to the application phase. We need to focus on what you, the learner, should be doing with this information right now. Knowledge without practice is, like you said, is just trivia.
So what does this all mean for the charts? How do we take these foundational month '01 concepts, the four conditions, valuation, the IPDA cycle, and apply them in practice, say, this week?
The priority in this initial stage is strictly observation and documentation. The sources strongly recommend 5 key homework items based only on these foundational concepts. First and most importantly, stop forecasting. Just resist the urge to predict price movements right now. Your mind is still retail-oriented, so focus only on objective observation of the framework we've just discussed.
Okay. And second.
Second, annotate your charts. Go through your chosen asset, doesn't matter if it's a currency pair or an index, and note every single area where price showed that quick, powerful movement, the expansion. Those big, impulsive candles or bars, they signal where the order blocks are, and they are highly influential for future price action. Third, identify liquidity pools. Look for areas where prices created recent highs and lows that just look too clean to be random. Those equal highs and equal lows in close proximity that haven't been retested or cleared yet. These spots are essentially labeled targets for the IPDA. They are future destinations for institutional delivery.
So those are the clusters of stop losses that the Judas swing is often aiming for?
Exactly. Fourth, define the range on multiple time frames. Drop down to the daily, the 4-hour, and the hourly charts. And for every visible impulsive swing, identify the equilibrium, that 50% midpoint, to clearly delineate the discount and the premium zones. Just get comfortable measuring the OTE levels inside those zones. And finally, document price delivery. Build your conviction by systematically documenting price action every single trading day. Specifically, look for how price interacts with that 50% equilibrium line, and then note how quickly it moves away from order blocks that are located in those discount or premium zones. That repetition is what's key to internalizing the entire framework.
That systematic study approach is just crucial. Month 01 is literally about building the language and the conceptual framework. You need this context, these definitions, the structure, before you can even begin to successfully implement specific entry techniques. You need to know where to buy, which is the discount or the OTE, what to look for, the order block and expansion, and why it's moving, which is the IPDA cycle influenced by rates.
Absolutely. And so here's a final provocative thought for you to carry into your charting sessions. Price action is not an outcome of random chaos. It is a very specific, deliberate delivery based on institutional needs and codified by the IPDA. The key to successful trading is not mastering the market itself, which is futile, but mastering yourself and learning to get in sync with the predetermined algorithmic signatures that are constantly playing out on the chart. Start seeing the market not as a battlefield, but as a map designed by institutions, and you are simply learning their language.